Okay, I'm going to take a quick few minutes and describe three price action based trade setups. Uh, these are not reasons specifically to get into trades. These are price action based setups that I'll show you that are confirmed by the order flow information when a trader has a price setting up, I should say a trade setting up when they have proper context. They either have a supply and demand event playing out, or they have an equity shift taking place, or a combination thereof. And this discussion here is directed towards equity index instruments. The price action based setups combined with order flow information are the same regardless of what type of instrument you're trading. And this is my lower time frame chart. I only look really for these price action based setups on the lower time frame chart after I've already identified something in context on higher time frame chart or on an equities buy sell program chart, NYSE tick chart, when I'm looking for reasons why to get in the market. Once I have a reason to get in the market, then I come onto my lower time frame chart to actually trigger the entry. Okay, so I'm going to start showing you what are the difference between the three types of trade setups. Now, a newer or developing trader wants to stay away from counter trending. So we're not going to talk about that other than I'll point out what counter trending is. But we're going to talk about the gray area between counter trending and trend following. That's the trend formation price action based setup. And then the trend following setup. So these are the two setups I'm going to be talking about real quick. It's real simple. And let's just dig right in here and look at some price action. Okay, here we have market in an uptrend, and we'll kind of start from this point going forward. I have a high pivot here. I have price pulls back, lifts, and rolls over. At the moment, I had a lower pivot high by one tick, and then the price action rolled over and gave me a red candlestick close. At the close of this candlestick, I see Delta was printing a red moving average line segment, as was up down tick. That is a perfectly aligned, everything in alignment, trend formation setup. And actually you can see we have pivot high, lower pivot high, close. That's the trend formation. The first time the price action confirmed a trend formation setup or entry point. I have a secondary lower high, pivot, price lifted, was lower by a tick, rolled over again, and at the close of this candlestick, everything was still in alignment. That is the trend following setup. That is the kind of a sequential or a secondary entry. So you can't have a trend following setup until you've already had a trend formation. So the first equal or lower pivot high and roll over and close after a new high is a trend formation setup. Any secondary ones are trend following. Next, I have price pulls back, lifts, rolls over, red candlestick closes, everything's still in alignment, and in this case, this is a secondary trend following setup. It's an additional equal or lower pivot high and rollover since the last one that I just indicated, and it is at the midband area or higher. I'm not going to consider short setups that are more than 2 ticks below the midband. So anything that's 2 ticks below the midband at where I can get in at entry price or above is where I want to be a seller in the market. Any long setups I want to be 2 ticks above the midband or below. So retail pricing, chasing price to be a seller is selling below the midband. Getting wholesale pricing levels to be a seller is 2 ticks from the midband or above. Okay, I get another lower pivot high. We get price lifts, rolls over, closes again. Another trend following setup. In this case, the close was about 2 ticks below the midband. So that's the lowest acceptable area I can be a seller. And many times I advocate when price closes below the midband as a seller to go at least 1 tick of price improvement. Same thing if I'm trying to get long in the market and I close 2 to 3 ticks above the midband, I have to make sure that I go for some price improvement so that I can get filled no more than 2 ticks away from the midband to be a buyer, or no more than 2 ticks below the midband to be a seller. So 2 ticks below the midband and above is my sell area. 2 ticks above the midband and below is the area where I'm allowed to buy. So these were trend formation and then trend following setups. Market comes down. has a little bit of a downtrend, lift, pullback, lift. Right here, this is the first time I have a higher pivot low and a candle close. At the moment, Delta has not yet printed a green line segment. Uptick, downtick has. Delta's right on the line, so I really don't have anything properly setting up. I wait a candlestick. At the close of that candlestick, now I have price closing green after the first higher pivot low. I do have deltas gone green, line segment stayed printed in up down tick. That's my first trend formation long setup. Price pulls back to an equal pivot low, lifts and closes, and delta and everything is red. I have nothing there, and now price starts trading lower. Price lifts, trades even lower, still nothing. Price lifts, pulls back, lifts. Here's my pivot low, here's my higher pivot low, candlestick closes green, and at the moment everything was just had turned green. So that is a trend formation long setup. My first higher pivot low with lift, a green candlestick close, and delta shifting green and uptick downtick. At the close that candlestick was green. I get equal pivot low lift, so now I'm looking for a trend following long. And at the time, delta had a green candlestick, but the right line segment was still red, as was up down tick, so no signal there. And by the time I get this additional signal, we're too far away from the mid-band. So trend formation long setup that was qualified. Now again, this doesn't mean I'm going to enter all these trades. It just means that the price pattern and the order flow information that I pay attention to and the order book resistance information was in alignment. Okay, price lifts, pulls back, lifts, rolls over. I have a lower pivot high and rollover, and at the close of that candlestick, I have delta printing a red line segment, uptick, downtick red. I have a trend formation short setup. I now have price lifting up, still below the recent pivot, rolls over again. At the moment, everything was red. That is a trend following short setup at the close of that red candlestick. Because I had up down tick, delta had just turned red, up down tick had just turned red. Next one, lift, equal pivot high, roll over. Everything on this next price action based setup is not yet in alignment because delta line segment's green, uptick down line segment's green. After that, price runs away from the mid-band, nothing to work with there. Price pulls back, lift, pull back, equal pivot low, lift. At the close of this candlestick, delta was green, uptick, downtick was green. That is a trend formation long setup. So we had equal pivot lows, lift, and that is trend formation. Price pulls back lower, lift, pull back, lift at the close of this green candlestick. It's our first higher pivot low since the market had made new lower pivot lows. And at the close of that candlestick, delta had gone green line segment, and uptick, downtick had just printed a green line segment. So that is a qualified higher pivot low trend formation entry. So anyhow, this is just a quick example of what is the difference. Trend formation is the first lower pivot high after an uptrend where we get a rollover and close. That's qualified. A trend formation long entry is the first higher pivot low with a positive close where we have everything in alignment. Trend following to the long side would be if we get sequential higher pivot lows and positive closes after the trend formation entry. So you can't have a trend following long or short entry until you've already had the trend formation. Trend formation is always about buying the first higher pivot low or selling the first lower pivot high. So that is the difference between trend, counter trend. Counter trending, of course, would be I'm selling the first rollover from a new pivot high. That's counter trending, and that's the lowest probability type entry. Trend formation is getting closer to 50-50 natural win-to-loss ratio. Trend following is getting closer to about 60% natural win-to-loss ratio. So trend following is the highest probability natural setup when you just backtest and look at price action alone. Every time you're working a counter trend setup, you're just naturally working a price action based pattern that is of lower probability. So I wanted to point this out, and the key is for newer developing traders, try to focus on working trend formation and trend following entries and try to stay away from counter trending entries.